Hello guys, this is Imran and welcome back to another episode of Financial Accounting Tutorials. Today we'll be talking about investment property. First and foremost, we should first understand the definition of investment property and the scope of the application in order for us to identify what are the inclusions and exclusions in the computation of the total investment property. These are all found under PAS 40. PAS 40 shall be applied in the recognition, measurement, and disclosure of investment property. The exclusions of applications under PAS 40 are the following: accounting for leases other than measurement of lessee's investment, property interest held under a lease accounted for finance lease, and measurement of lessors investment property leased out under operating lease. Biological assets related to agricultural activity, mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources. So under PAS 40, investment property is defined as property. Examples are land or a building or a part of a building or both, held to earn rentals or for capital appreciation or both. The following are not considered as investment property and therefore outside the scope of PAS 40. Property held for use in the production of supply of goods or services or for administrative purposes. Property held for sale in the ordinary course of business or in the process of construction and development for such sale. Property being constructed or developed on behalf of third parties. Owner-occupied property, such as property, plant, and equipment under PAS 16, including property held for future use as owner-occupied property, property held for future development and subsequent use as owner-occupied property, property occupied by employees, and owner-occupied property awaiting disposal. Property leased to another entity under a finance lease. These, on the other hand, are examples of investment property. Land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. Land held for currently undetermined future use. Building owned by the entity and leased out under one or more operating lease. Vacant building held to be leased out under an operating lease, and property that is being constructed or developed for future use as investment property. Only land and building may qualify as investment property. However, the land and building must be rather neither owner-occupied property, inventory or asset held for sale under PFRS 5. There you have it. Now, since we already know what is and what is not included in investment property, let's try to solve this problem.
ABC Company has the following assets: land held for long-term capital appreciation, 200,000. Land held for a currently undetermined future use, 700,000. Land held for future plant site, 1 million. Land held for sale in ordinary course of business, 100,000. Building rented out under finance lease, 1,900,000. Building rented under operating lease, 800,000. Building held under an operating lease, 1,100,000. Building held under finance lease and rented out under operating lease, 1,200,000. Equipment leased out under an operating lease, 50,000. The requirement is to determine the total investment property. The land held for future plant site and the equipment leased out under an operating lease are classified as PPE. The land held for sale in ordinary course of business is classified as inventory. The building rented out under finance lease and the building held under an operating lease are not considered as assets of ABC Company. Those are the lessee's assets. Therefore, the following are the only assets included in the investment property. Land held for long-term capital appreciation, 200,000. Land held for currently undetermined future use, 700,000. Building rented out under operating lease, 800,000. And lastly, building held under finance lease and rented out under operating lease, 1,200,000, for a total investment property of 2,900,000.
Okay, let's move on to other classification issues of investment property. First is the property that is partly investment property and partly owner-occupied. This property comprises a portion that is held to earn rentals or for capital appreciation and another portion that is held for use in the production or supply of goods or services or for administrative purposes. The scenarios of properties are accounted as follows. If portions could be sold separately, an entity accounts for the portion separately. If the portions could not be sold separately, the property is investment property only if an insignificant portion is held for use in the production or supply of goods or services or for administrative purposes. If the owner-occupied portion is significant, the entire property is classified as property, plant, and equipment. For better understanding, let us take into consideration these following cases.
Case 1. Portion sold separately. ABC Company has a 10-story condominium building with a carrying amount of 4 million pesos. The first floors are being rented out to tenants under operating lease and the rent are used as office space. Each portion of the building can be sold separately or leased out separately under finance lease. Requirements. Assuming that the fair values of the condominium units are approximately equal, how much is classified as investment property and how much is classified as owner-occupied property? Answers. A. Investment property, 4 million times 4 divided by 10 equals to 1,600,000. And B. Owner-occupied property, 4 million times 6 divided by 10 equals to 2,400,000. Case 2. Portions not sold separately. PPE has insignificant portion. ABC Company owns a 100,000 square meter mall. The rentable space is 800,000 square meters. However, a 10 square meter space is occupied as an administration office. The carrying amount of the building is 10 million pesos. Requirement: how much is classified as investment property and how much is classified as owner-occupied property? Answers. A. Investment property of 10 million pesos and B. Owner-occupied property of 0.
Second, the ancillary services to occupants. When ancillary services are provided to the occupants of a property held, the property is classified as investment property if the services are insignificant to the arrangement. An example of this is when the owner of an office building provides security and maintenance services to the lessees who occupy the building. If the services provided are significant, the entire property is classified as owner-occupied property. An example is services provided to hotel guests in an owner-managed hotel. Lastly, investment property in consolidated financial statements. Qualifications for this class of property is based on the following. Entity owns property that is leased to and occupied by its parent or another subsidiary. This property does not qualify as investment property in consolidated financial statements. From the perspective of the entity that owns it, the property is investment property if it meets the definition of Class 40. Therefore, the lessor treats the property as investment property in its individual financial statements. Moving on, let's now discuss about the recognition and measurement of recognition of investment property. Investment property shall be recognized as an asset when and only when it is probable that the future economic benefits that are associated with the investment property will flow to the entity. The cost of the investment property can be measured reliably. Investment property is initially measured at its cost, including transaction costs. Such costs should not include startup costs, abnormal waste, or initial operating losses incurred before the investment property achieves the planned level of occupancy. These exclusions are expensed immediately. So let us proceed to investment property held under a finance lease. The initial cost of an interest of the property held under a finance lease that is also classified as an investment property shall be recognized in two ways. At the lower of the fair value of the property and the present value of the minimum lease payments. If there will be instances that amount is equivalent, then it shall be recognized as a liability. Any premium paid for a lease is treated as part of the minimum lease payments. Therefore, it is included in the cost of the asset, but is excluded from the liability. If a property interest held under a lease is classified as investment property, the item accounted for at fair value is that interest and not underlying property. Let us move on to the next, which is exchange. An investment property may be acquired in exchange for another non-monetary asset, or assets, or a combination of monetary and non-monetary assets. If the exchange has commercial substance, the investment property acquired is initially measured using this order of priority. So first, fair value of the asset given up plus cash paid or minus cash received. Second, fair value of the asset received. Third, carrying amount of asset given up plus cash paid or minus cash received. To know if an exchange has commercial substance, the future cash flows from the asset received significantly differ from those of the asset given up. If the exchange lacks commercial substance, the investment property acquired is initially measured at the carrying amount of the asset given up, plus cash paid or minus cash received. To further understand, here's an example.
ABC Company has the following transactions during the year. First, purchased building to be held as investment property for 1 million pesos. Direct costs incurred amounted to 20,000. Cost of day-to-day servicing for asset totaled 5,000. Constructed building to be used as investment property. Total costs incurred the following: materials, labor, and overhead amounting to 2 million, startup costs amounting to 100,000, operating losses amounting to 50,000, and lastly, abnormal amounts of wasted materials during construction amounting to 20,000. Next, land acquired with currently undetermined future use by issuing note payable with face amount of 1 million and a present value of 800,000. Building acquired through finance lease to be rented out under various operating leases. The fair value of the building is 530,000 and the present value of minimum lease payments is 500,000. Land to be used as investment property to be acquired through exchange. Fair value of asset given up in exchange for the land is 3 million. Fair value of the land received is 500,000. This exchange has commercial substance. Requirement: how much is the total cost of investment property on initial recognition? Purchase building 1 million plus 20,000 equals to 1,020,000. Cost of investment property plus direct cost. Cost of day-to-day servicing of asset is expensed. Constructed building, material, labor, and overhead 2 million. Startup costs, operating losses, and abnormal amounts are not included in the cost of investment property. They are expensed immediately. Land acquired through deferred settlement at PV of note 800,000. Building rented out under financial lease. Lower of fair value and present value of minimum lease payments 500,000. Land acquired through exchange, fair value of asset given up plus cash paid 3 million plus 500,000 equals to 3,500,000 for a total initial costs of investment properties of 7,820,000.
Since we now know how the investment property acquired is initially measured, let us take into account the subsequent measurement of the investment property. After the initial recognition, an entity shall choose one of the following as its accounting policy. So first, fair value model, wherein an investment property is measured at fair value, with the changes in fair value are recognized in profit or loss. Second is the cost model, wherein an investment property is measured at cost less accumulated depreciation and accumulated impairment losses. When an entity chooses an accounting policy, it should be chosen for all of its investment property consistent from one period to the next. The use of both models is prohibited. For example, when an entity chooses for fair value model, it should be applied to all of its investment properties, same as when an entity will choose the cost model. An entity can change the accounting policy when it has previously chosen the cost model, provided that the change will result to more reliable and more relevant information. It will be accounted prospectively. An entity who had previously chosen fair value model cannot subsequently change the cost model because it is highly unlikely that changing the cost model will result in a more relevant presentation. Lastly, FAS 40 requires all entities to determine the fair value of investment property, whether it uses fair value or cost model. An entity choosing the cost model as its accounting policy is nevertheless required to determine the fair value of the investment property, but this is for disclosure purposes only. But for fair value model, it is used for both disclosure and measurement purposes.
Change in accounting policy. ABC Company has an investment property with a carrying amount of 1,100,000 and a fair value of 1,300,000 on January 1, 2021. Case 1. If ABC Company decides to change its accounting policy from the cost model to the fair value model, how much is the gain or loss on the change? What is the entry to affect the change? On January 1, 2021, debit investment property 1.3 million less 1.1 million is equal to 200,000 and a credit unrealized gain from change in fair value of 200,000. Case 2. If ABC decides to change its accounting policy from the fair value model to the cost model, how much is the gain or loss on the change? What is the entry to affect the change? The answer is none. ABC cannot change from fair value to cost model.
Fair values of investment property are determined at the end of each reporting period. Determining the carrying amount of investment property under the fair value model, an entity does not double count assets or liabilities that are recognized as separate assets or liabilities. So the cost model. In here, after recognition, an entity choosing the cost model will measure all of its investment property at cost, less any accumulated depreciation and impairment losses in accordance with the cost model under PAS 16, Property, Plant, and Equipment. If the investment property subsequently qualifies for recognition as held for sale under PFRS 5, non-current assets held for sale and discontinued operations, such property will be measured under PFRS 5. If an entity completes the construction or development of a self-constructed investment property that will be carried at fair value, any difference between the fair value and its previous carrying amount shall be recognized as profit or loss.
Example, on January 1, 2021, ABC Company started constructing a building to be used as investment property to be measured at fair value. The building had a fair value of 6,100,000 pesos and a carrying amount of 6 million pesos. Solution, January 1, 2021, debit investment property of 6,100,000 pesos, credit various appropriate accounts for 6 million pesos, and credit unrealized gain on change of fair value of 100,000 pesos.
Hey, thank you for watching. I hope you learned from us. If you like this video, give this video a thumbs up and please subscribe.